When it comes to your financial future, you want to make sure that you're taking the right steps to protect yourself and grow your money. We'll take a look at some of the different aspects of investment planning and help you figure out which option is best for you. Investment planning is an essential step in any individual's financial plan. There are many types of investments available, each with its own set of risks and rewards. We will provide an overview of the 3 most common types of investments and their associated risks. The stock market is the most visible type of investment, and also the riskiest. Stock prices can rise or fall rapidly, causing a significant amount of volatility in an investor's portfolio. In addition, stock market investments are typically riskier than other types of investments because they involve the risk of loss from price fluctuations alone. Real estate is another type of investment that can be risky, but it can also be extremely profitable if done correctly. Like stocks, real estate prices can rise or fall, and property may not appreciate as quickly as you may hope if you invest in a property that is not in a desirable location. However, if you invest in a property that is in a desirable location, your investment may be worth far more than the original cost. Fixed income securities are some of the safest and least volatile types of investments available. Fixed income securities are investments that provide a predictable stream of income over a fixed period of time. They are often considered conservative investments because their returns are not as volatile as those of stocks or mutual funds. When it comes to investing, there are a few things that you should keep in mind. One of which is the danger of overinvesting. Overinvesting can lead to a lot of problems, including losing money, being unable to sell your assets, and even becoming financially unstable. Another danger of investing is the risk of getting pulled into a market crash. A market crash can lead to a loss of your entire investment, and may even require you to start from scratch. It's important to stay aware of the markets so that you can avoid these risks, and make sure that your investments are appropriate for your goals and financial situation. There are a number of reasons why investing in stocks or other forms of securities can be a smart decision. Here are some of the key benefits. Investing consistently over time will result in increased income as your portfolio's value grows. This is because the value of your investments will increase as the market does, provided you are holding onto them for a reasonable amount of time. Many investors enjoy tax benefits when they make investment decisions. For example, if you have income from your investments, you may be able to write off a portion of that income against your taxes. Investing allows you to protect yourself from potential risks in the stock market, both short and long term. For example, if you have money invested in stocks that are down in value, you may still come out ahead if the overall market goes up over the long term. On the other hand, if the stock market falls significantly short of expectations, your investment could lose a significant amount. There are 2 main time horizons that investors use: short-term and long-term. The short-term horizon is the time it takes for an investment to pay off, while the long-term horizon is the time it takes for an investment to generate a return. The compound effect of investments can have a very large impact on their returns. For example, if an investor has $100 invested in a stock that increases in value by 10% each year, their total investment would be worth $110 at the end of the 5th year, $120 at the end of the 7th year, and so on. Investment planning can be difficult, but with the right tools and advice, it can be a lot easier. Here are some of the most popular investment tools. A mutual fund is an investment that pools money from many people and invests in a variety of securities. Mutual funds are often recommended to people who want to invest for the long term because they offer a diversification benefit. ETFs are similar to mutual funds, but they trade on stock exchanges as stocks do. This means you can buy and sell them quickly, which can give you more flexibility in how you use your money. An index fund is a type of mutual fund that tracks an entire market or sector. By doing this, it offers some of the benefits of owning individual stocks without the risk. Certificates of deposit or CDs are savings accounts that offer fixed interest rates for a set period of time. They are usually a good option for people who want to keep their money safe and secure. If you're thinking about starting your own investments, there are a few things you need to take into account. Here are a few tips on how to get started. Do some research on the specific industry you want to invest in, and figure out what trends are happening. This will help you identify opportunities early on and make better decisions when it comes to investing. Don't invest all of your money in the first couple of investments you make. Use a smaller percentage of your total portfolio into each investment, and gradually increase that percentage as you become more familiar with the industry. This way, if something goes wrong with any of your investments, you won't lose everything that you've invested so far. Don't let yourself get too wrapped up in the profits or losses of individual investments. Remember that the goal is to grow your overall portfolio over time. Stick to a long-term investing strategy and focus on doing your own research rather than relying too much on third-party opinions. Good luck! Thank you for watching. The above is not financial advice and is only for education purposes. If you enjoyed this video, please hit like and subscribe and share this with your friends. Thank you.